I hope you're having a great day, guys. Today we're going to be talking about Palantir, a very, very popular stock in the stock market. And more specifically, we're going to be talking about why it's time to take your profits in Palantir and use it to buy something else. Some of the things we're going to be talking about is the share dilution, the insider selling, the insanely high stock-based compensation that we're going to be going over today. So stick around. So if you don't know about Palantir, Palantir is an AI company. They were founded in 2003 by this mad wizard, Alex Karp, who's now worth $3.4 billion. And I believe he was part of PayPal as well. Now, Palantir was very early into AI, and what they have 4 AI kind of system softwares, hardwares that they're just killing it with. So we can see a lot of news here. Palantir ranked number 1 in worldwide artificial intelligence, ranked number 1 AI, named the leader in AI and ML platforms. They have been killing it. Their revenue is growing very nicely, 27% up year over year. And where do the revenues come from? We can see that still more than 50% of their revenue is coming from government contracts. And they're getting more and more contracts, bigger and bigger contracts that are going to be making them a lot more money. And the other side is the commercial. So on the commercial side is where it's very exciting as well, because they're getting a lot more contracts from huge companies like Wendy's, like Microsoft, that I thought would pop up right here, but they did not. So that is very bullish on them. And they have a bunch of things. They have a free tier for developers coming out. So there's a lot of things going on with the company that are very good. The revenue is growing up 27% year over year. It is very nice, steady, disciplined revenue that is consistent. And whoever starts using Palantir pretty much will continue to use it because it is just a game changer. Who goes to AI, it doesn't go back. So we can see right here, 6 months added, revenue is up 30%, 1.3 billion. And the cost of revenue, guys, is only 244 million. So that would mean a gross profit of $1 billion. That is an insanely profitable company. But then again, this is a growth stock, so they're trying to expand. Almost double their cost of revenue is their sales and marketing. Another 200 million in research and development and 270 million in general and administrative costs. So these expenses add up to $880 million. So these guys are investing in their growth, and the growth is showing. Now, if you look at the balance sheet, it is looking pretty healthy. They have 500 million in cash, down year over year, and they have $5 billion in assets with only $1 billion in liabilities. So on the outside, this looks like a very healthy stock, but sadly, it is not very shareholder friendly. Because right here, stock-based compensation is $267 million for 6 months only. Last year, it was $228 million. So if you look at this, $267 million in what's called stock-based compensation, while their net income was only around $200 million. So 100% of their net income is going back to stock-based compensation. That is what I really don't like about this company. They're just rewarding themselves way too much. And if you look at this, they are healthy, right? They should be using their own cash or raising some debt if they need money. But no, they choose to dilute shareholders. We can see here quarterly, they just keep raising more and more shares. If you look at right here, we can see that the shares outstanding are up 6% year over year, while their revenue has grown 21%. And if you look at the valuation, they're selling at a price to earnings of 170 right now, which might be wrong. Let's check what Yahoo says. So right here, 170 times earnings. Now, if you look at the forward earnings, they're supposed to be selling at 80 times earnings if they grow along their guidance, like they probably will. But still, insanely overvalued. If you look at the free cash flow to price, 99 compared to the 4-year average of 117. So this is fairly valued. But then if you look at price to sales, they're trading 27 times sales. 4-year average is 18. And if you look at the forward price to earnings growth, trading at a 1.35. So 1 is good and 1 is healthy. Anything under 1 is very good. And these guys are over 1. And then let's say what the management is doing with their prices. So if we look at their insider selling, everyone has been selling. We can see even the president, co-founder, secretary, and director has sold 166,000 shares, $5 million worth of shares. And now he only has 500 shares left. And this was in August. This was this year. They sold it at $30 range. So everyone in the insiders is selling. Oh, okay, not a lot. You can say all these guys still hold massive amounts of shares because they are bullish in the company. The company's not going anywhere. Don't get me wrong, but I just don't think this is the right time to buy the company. And I think this is the right time to sell your company, to take your profits. Don't be afraid to take profits. So Peter Thiel himself sold 8%. Since 2023, he's sold 8% of his shares. He still holds 5% of the company. So it's not like he's saying this company is going to trash. It's not. But it's just overvalued in my opinion. And one thing I'd like to show you is here we can see number 1 in AI. Great news. So we can see Apple is investing in Microsoft OpenAI, and Microsoft uses Palantir. So this will be positive for Palantir as more companies go into AI, and Palantir just has, we can see, the best AI there is. Institutions are also just breaking in and buying up more shares. But be like this guy, guys. Thanks to Palantir, he sold his Tesla and bought a new AMG. So that's pretty much what I'm saying. We went over the share dilution, insider selling, high stock-based compensation, just insanely high. And that is why I'm not currently buying the stock. Now, if we look at the technical analysis, we can see that the stock is doing great. They're at a crazy uptrend right now, and they could continue this. They're almost at the all-time highs of $35, and they could very much go there. They're above the moving averages, higher highs, higher lows. But especially if you bought in the $8 range or even the $20 range, take your profits and go put it somewhere else. Thanks for watching, guys, and comment down below what you think. Thanks for watching, and I guess we can go through this. So again, company is growing very nicely. Revenue is projected to be 740 million for the last quarter of 2024, while earnings, they beat the earnings so much. But then again, all those earnings, they paid back to themselves as stock-based compensation. So that is not very shareholder friendly at all. Free cash flow, we can see pretty healthy. But if you look at the valuation, price to sales, 27 times sales, while the industry average is 9. Price to earnings, 178. Industry average is 36. Price to book, 16 times book value, while the industry average is 10. So if you look at any metrics, this company is overvalued. And even if you count in the projected earnings growth and the revenue growth, I think still at this level, this is way overvalued. They did leave a little gap at $17. And at $17, it's a good buy. That's what they were selling at in 2021. But right now, I just think this is not the right time to buy. So if you guys want to see what stocks I'm buying and what stocks are better buys and also great companies just at a better price, follow me, subscribe, and like the video, and comment down below what stocks you guys are buying, and I'll make a video for you guys. Because if you stick to the end, thank you very much, guys. You made my day, and have a great day. I'll see you in the next one.